Welcome to Stearns Financial Group's live Let's Talk About It chat. This is Glenn Joyce filling in as moderator as Dennis Stearns takes a well-deserved break. Today we will be considering what now as we assess recent financial market and economic data and discuss how all this factors into SFG's current investment outlook. Note, this will be conversational. And so at the risk of making or showing you how the sausage is made, we hope folks do gain some perspective on the internal dialogue and perspectives as we hash out these more complex topics. We welcome your feedback and questions. Today, I'm excited to be joined by three of my colleagues here at Stearns Financial Group. Providing commentary as we review this presentation will be Lindsay Brock, financial advisor and certified financial planner practitioner, as well as two members of our investment committee, Dax Dixon, financial advisor and chartered financial analyst charter holder, as well as Jason Croy, financial advisor and chartered financial analyst charter holder. Now that we have set the agenda and introduced our speakers, let's jump right in. Next slide, please. So as we continue to reopen the economy, a chief concern is a potential second wave of coronavirus infections. Lindsay, what are your thoughts here as we are seeing the potential ramifications for the economic recovery?
Well, thanks, Glenn. And some people are referring to this as a second wave, but a second wave might infer that we are finished with the first wave. I do encourage you to consider rather that this is maybe a second peak in our first wave. A second wave might still yet to be to come this autumn. So national COVID counts are slightly lower than the peaks were in March and April, but they are increasing in certain regions. While that's due in part to the number of tests performed, the percentage of tests returning positive is also increasing. Yesterday actually was the largest one-day increase at more than 37,000 cases, led by Florida, Texas, California, and Arizona. The good news is that we haven't yet seen the death rate climb at the same rate. This can change over time though, or it can be an indicator that the most vulnerable members of our community are staying cautious. In fact, we've seen that the average age for these new cases is actually close to age 37. This particular chart is showing the 10 most affected countries. You can actually see the trajectory of the case count over this period as most countries, including most of our states, continue to open up businesses. However, this week we've seen some states like Nevada, Texas, and Florida threaten to slow or halt their opening rate. Here in North Carolina, we are remaining in phase 2 through the middle of July. So if you flip to the next slide, what are we doing for this, or what is the government helping us along to do? Most of us are aware of the great lengths that the federal government has gone to help with fiscal and monetary stimulus over the last couple months. For example, the Fed is doing more than we traditionally thought of for its mandate. After their June 10th meeting, Chairman Powell announced that they intend to keep the Fed funds rate where it is through 2022 and continue to expand its balance sheet. This is a big deal. On this slide, you can see that the Fed's balance sheet has surpassed $5 trillion for the first time in history and may actually continue to rise until this crisis is over. What's more, in their June 15th statement, they announced that they'll be buying individual corporate bonds rather than just bond ETFs. They also reiterated that they have other tools on hand, and they've encouraged Congress to provide additional fiscal stimulus. So we'll have to keep watching for that.
I think that's the key point, Lindsay. Obviously, the stimulus on the part of authorities has created a bridge, and the question is, will the bridge be enough to get us across this economic abyss or this uncertain area we are in economically? So I think obviously investors have gravitated to that, the don't fight the Fed mantra we've heard about in the past. So obviously a key consideration as we go forward.
Right. And if you flip to the next slide, so really, why is there such a disconnect between the economy and the markets? Investors, as you can see, are feeling extremely optimistic. This particular chart is from one of our favorite research partners, Ned Davis, and it's showing the daily trading sentiment composite. You can see that at the beginning of 2020, all the way over to the right, the sentiment, the pessimism really did take over for the first few months of the year, coinciding with a lot of the fear having to do with the COVID spread. But recently, since about maybe March 23rd, the low in the markets, we have seen this intense optimism, positivity take over with investors. Really, this year, we've seen a lot to talk about. We've seen the fastest bear market in history. It took 20-something days for the stock market to lose 1/3 of its value, and we've never seen that in history. Immediately following that, which is wild, we saw the best 50-day rally ever, with a return of more than 39% for the S&P 500.
Yeah, and I would just add in here as a comment, measures like this are things that that help inform our investment conversation, but you can see how volatile the mood swings can be in the market in any given point in time. And so we don't use data like this as a short-term trading indicator or a short-term repositioning indicator. It's really just kind of part of the mosaic of information we're trying to digest to see, how is the market feeling, or what mood has the market been in, or market investors been in over the past few months. And so, as you can see with the market rally, people have been quite optimistic going into today.
It's a great point, Jason. So as we turn to the next slide, DAX. So it seems, Wall Street and investors are largely optimistic and have a "we will get through this" perspective, perhaps. What are we hearing from Main Street?
Yeah, that's an excellent question, Glenn. I think that over the past 5 or 6 weeks here at Stearns, we have been talking about the huge disconnect between what we're seeing out of this, the markets in Wall Street and what's happening on Main Street. I am happy to report, though, that today I am getting my first haircut, so I'm supporting Main Street since the stay-at-home order. It got so bad, Glenn, that even the neighborhood dogs were starting to tell me how shaggy I was looking. So as we see in this particular chart, no matter where your Main Street is located, all small businesses across the country are suffering. And a large part of that is obviously due to the economic shutdown. And as Lindsay did a great job in covering what the Fed has done from a monetary perspective, and I think that that's putting wind at the sails of the market right now. But you can see on this chart the first stimulus checks from a fiscal policy standpoint. So when Congress passed the CARES Act and all the fiscal stimulus that was embedded in that bill, those checks started coming in April, and some of our Main Street businesses across the country saw an uptick in revenue. They're very much still down from where they were pre-COVID, but they have seen an uptick there. And then later on, you saw when states started opening up around May 1st and some of those stay-at-home orders were loosened, you start to see an uptrend in revenue there. And so I think one of the main concerns we have is that first chart that Lindsay covered. Since those stay-at-home orders have started to be lifted across the country, we have seen an uptick in COVID cases. And if that continues to be a trend going through the summer, then we could see either a slowdown in the reopening of the economy on Main Street, or we can revert back to some of the more strict stay-at-home orders that we saw during April and the early parts of May. So with that, I think that we can dive deeper into how small business revenue has been impacted, as you can see here, but also what does that mean going forward if we do have a more prolonged recovery? Jason, any thoughts on your side on how this might impact the broader financial markets?
Sure. Well, certainly as businesses have seen revenues decline, companies are turning to the debt markets in greater degrees as a way to source cash. And so we looked a moment ago at the level of capital injection that the Federal Reserve has supplied, and mentioned that they've effectively created a backstop for much of the corporate debt out there. And I'm sorry, I forgot to ask Bill to go to the next slide. I think you're doing that. But this lending, or this stance by the Federal Reserve has essentially incentivized the lending practices of financial institutions, and that keeps cash flowing through the economy, and that's a good thing. But as those revenues have decreased, what we're seeing on this slide is we've seen a resurgence in references in the media and among a few clients to what are so-called zombie companies. These are businesses whose ongoing operations do not generate enough cash to keep the business afloat long term. But as the companies essentially continue to exist, from being able to go to the debt markets and borrow more money to cover their short-term cash needs, it creates a somewhat of an unsustainable event for a lot of businesses, or especially on the smaller side. And so this graph just really illustrates how the growth in the number of these cash flow companies has increased, really going back to the great financial crisis and some of the measures that were taken coming out of that. And it's hard to tell on the screen, but there's been a bit of an uptick lately in this trend.
Hey, Jason, what can you speak on regarding refinancing? Some of these companies might have refinanced at lower rates over the last decade or so.
Yeah, no, I mean, that's a good point. You know, there are going to be companies that use the debt markets in a prudent manner, and there are going to be companies that use the market, or they use the debt markets as a a way to just keep their business going, even though that they don't have the economic sustainability to keep to actually generate positive revenues on their own without that debt essentially covering their bills for them. You can kind of equate it. You use the word refinance. You can equate it on the personal side to if you were to go refinance a mortgage and you were able to reduce your monthly debt payment substantially. That tends to be a pretty good financial decision. But if you were using, say, a credit card to just fund your monthly expenses and to maintain lifestyle for a long period of time, that can have very negative consequences on your overall financial health. And so businesses are the same way. And what we've seen and what the slide is just trying to illustrate is that the number of companies that are relying on that debt issuance to keep their cash flow moving has really increased. And that is an area of concern when you're looking in the investment landscape. It actually dovetails pretty nicely.
Jason,
oh, go ahead.
Yeah, as to follow up on that, I think that a prudent manager and business leader would refinance to lower rates to lower the cost of capital, right? But eventually, a zombie company is a company that doesn't have positive cash flow, right? And so eventually, you're going to have to, quote unquote, pay the piper. Are you seeing any vibrations out there right now that is a concern with some of these companies?
Yeah, and that's actually a perfect segue into Bill. If you want to go to the next slide, the coincident effect of companies that are being low on cash is that lately we have started to see a rise in the number of firms that are filing for bankruptcy. And so the data on this slide are weekly figures that are compiled by Bloomberg, and the clear outlier is on the most recent reading on the far right that showed a large spike in the number of businesses filing for Chapter 7 or Chapter 11 protection. And this data, this particular data set, doesn't get granular enough to give an insight into what proportion of these companies reporting were smaller in nature versus big, or what proportion was of public companies versus private. And so there are other factors underlying the figures that could have a meaningful influence on the data going forward. But I think the takeaway is that you've heard us mention for several months now, going back even before the COVID-19 crisis, that in client portfolios, we've intentionally tried to tilt toward high quality businesses, both on the bond side and in the stock investments we make. And we're looking for companies that have healthy financials and real earnings power. And we're trying to find investment products that build the portfolios to tilt and favor those companies. And so, realizing that this one data point, you can see that the bankruptcy filings have been somewhat steady over the past few months. This one data point, this one jump doesn't make a trend, but it's something we're certainly going to be watching closely in the weeks ahead to see how the market may react to additional data points like this that show a rise in the number of companies that have gone insolvent. On the other side of it, dislocations like this in any investment world can also lead to some interesting investment opportunities. And so it's not uncommon that when that investor optimism that we talked about a minute ago, when it starts to sour, and when you see, potential data points like this, perhaps spook investors, you see good quality companies get thrown out with the bad ones. And so, how the market responds, whether or not subsequent data points start to show a rising trend in the number of companies that have had to file for bankruptcy, it's something that we're going to be watching to try to inform how we position portfolios. And we're going to be looking for areas in the investment landscape that may become more attractive because of this.
Those are great thoughts, and a key takeaway for me back to kind of the interest rate environment. And we are kind of fortunate right now. Interest rates are low from at least the regard of debt and financing. So obviously that's going to be a key thing to measure as we go forward, or interest rate and inflation trends as we go forward, and just trying to make sure we understand kind of the financial strength of some of these companies and how they can weather rising rates perhaps. But right now, that's probably a subject for a later day, because I don't know if anybody's predicting a big spike in rates anytime soon, which is something to think about. So Jason, thanks for that. And I think now we will turn our attention more to the global stage and look at some global economic data. And the International Monetary Fund announced this week that they did reduce their 2020 global economic forecast. They had originally come in with a contraction this year of -3% on economic growth, but now they've revised it even lower to down 4.9%. So they basically are saying that the recession is probably going to be a little steeper, and also a little slower recovery. And a lot of that's based on the virus spread, at least based on their initial observations. And so, a lot of that's going to depend on just continuing how we move forward. We thought this was going to be the deepest or the toughest recession since the Great Depression in terms of a down, but we were hoping it was going to be short, because we felt like it was self-induced or self-imposed by governments, and so we have a little more control on the backside. So the virus obviously is playing a key factor there, and we'll have to kind of see how what Lindsay discussed, how much that plays out as we continue to open up the economy. I guess the good news is the International Monetary Fund does expect global economic growth to pick up next year, 2021, to about 5.4%, but that would still be below earlier forecasts. And a lot depends on whether we need additional stimulus measures, but whether additional stimulus has to come forward to help people make ends meet and create that bridge we discussed earlier. So far, I think there's about 11 trillion in fiscal measures that have been announced thus far by governments. So the IMF does say there's a high degree of uncertainty around their forecast right now, so take it with a grain of salt. Obviously, we're in uncertain, very complex times, but once again, we will be hopeful and continue to monitor things as we continue to try to reopen the economy and monitor the spread of the virus.
Hey, Glenn?
Yes.
Quick question for you. I know that the head of the ECB came out last night, and she's of the opinion that Europe is sort of on the other side of their COVID recovery, at least. So whether it's this year or early next year, do you see maybe international markets having a little bit quicker recovery than we're seeing here in the U.S.? And what does that mean, like, from an investment perspective and the opportunity set that we're seeing out there?
Yes, Dax, that's a very interesting comment. And I think, you think about the progression of the virus, it was from east to west. And so we are seeing, signs that some of the countries further east maybe are further along. Although in China, we have seen a little bit of a pick back up in certain pockets. I mean, I think the concern for Europe is, like a lot of advanced economies, is that older demographic profile they have. And obviously, Lindsay mentioned that the age is coming down, so maybe that's improving the overall stats. We definitely are worried about those that may be more vulnerable. But I think that's a good point. And I think, I think she also said that it could be, very uneven. Also, things could change permanently on the backside of this. And the global trade obviously is a concern going forward, especially if China and U.S. continue to have conflict. And so I think it's really one of these situations where, once again, it's very complex, could be very uneven, both geographically and across sectors, depending on how we recover here. And so it's going to, once again, make predicting economic growth forecasts very challenging as we look across the globe in different pockets. But a great point. And so I think now we want to kind of transition that and kind of come back and say, okay, well, all these challenges that we got on the economic growth front and trying to figure out where we're going in different sectors and how it's impacting the economy. Jason, kind of how does this kind of go back to U.S. corporate earnings forecast? I know that's been another area that's been very complex. Any thoughts there?
Yeah, so, much like what's going on in the IMF, as new data has come to light about the path of the virus and how different government agencies are responding to it. The research analysts have been updating their expectations for future earnings and how companies are going to be able to perhaps generate profits in the months ahead. On this slide, we show how much like the economists at the IMF, analysts have are now expecting that the earnings numbers for companies are going to be lower than what they had thought a few months back. on the chart, the blue bar is labeled today. It's actually as of June 19th, about a week ago. And you can see that compared to the expectations at the end of March, those already bad numbers have gotten a little bit worse. And in this case, no sector has been immune from a decrease in the expectations. And we don't show it here, but revenue forecasts have had the same revision trend. And so we're seeing the top and bottom line expectations decrease meaningfully across the board. One factor potentially playing into this is that we've only seen a handful of companies actually issue guidance for the second quarter. And so analysts are doing their best to decipher how all of this economic craziness is going to affect businesses, but they're having to do so without the businesses providing any internal projections at the same level that they have in the past. And so, as with any prediction of the future, we view the figures on the screen not as hard targets, but as just some guiding lines. I'm not going to comment on the economists' ability to forecast the future and their track record with that, but whether the IMF's 4.9% drop in global GDP ends up being spot on, or if it comes in at negative 5.2, that probably doesn't make a big difference in the way we approach the investment outlook or the investment strategy. And the same thing is true with the earnings forecast. We know that this quarter is going to be bad. We know this reporting season is going to be probably further off than what we've seen in history, or at least in recent history. And so whether the number for the S&P comes down at 43.8% decrease like we see on the screen, or make it up if it's at 42.1, that's probably not going to change the overall strategy. But something that these lowered forecasts do bring to the table is, I'm sure the analysts have sound reasoning for making their adjustments, but they've effectively set the bar a lot lower. And so as companies begin to report, again, going back to that market sentiment that we looked at, if companies have a lower threshold or a lower benchmark that they are trying to beat in terms of their earnings, there could be some large discrepancies between what the analysts are expecting and what the companies are actually able to deliver. And so if we see a positive discrepancies, particularly in some of the larger companies, that could add some fuel to the buying fire a lot more. And so there could still be some positive outcomes from the market, despite the expectations going lower that companies are earning less, if the market's willing to discount this quarter and look forward over the next several quarters into next year, and effectively, with the assumption that we're getting companies cheaper than what they will be a few years from now. We've seen this occur in past episodes of economic turmoil. I think the next slide is actually going to take a look at that. Dax, you want to talk about it a little bit?
Yeah, absolutely. And this next slide just looks back at the history of the past few market crashes to show, how steep some of the recoveries have been in the past. And we're certainly experiencing some of that. So I'll focus in on the green line a little bit here, which is the global financial crisis, which reached the bottom on March the 9th, 2009. So over the subsequent year, it went up about 68%. So that was a period when probably similar things were happening in the market as far as re-rating earnings lower over that period. So the market often is going to look to the future and in anticipation of those earnings coming back. And I think that that's what we're seeing right now with the strong recovery since some of the March 23rd lows, is that the market has sort of overlooked Q2, Q3, maybe all of 2020 earnings at this point, looking out to 2021. And that's especially true in an environment where interest rates are at all-time lows. So your discounting mechanism is even smaller. So those future earnings are effectively worth more. I will note on this slide, though, is you can see even in 2007, if you look at the 1 year mark, it was up 68%. And then if you look at the around 2.5 year mark, it's about in the same place. So you saw that volatility from 2009 through 2011, and we may be entering a similar type environment as some of the uncertainties unwind themselves over the next 6 to 12, 18 months. We could see a market that goes up 10, 15%, goes down 10, 15%, and is trying to find its footing to break out. And that may take a few years, especially with the nature of a global pandemic. all that said, we are seeing investors both going to the stock market and going to the safest asset, which is cash. Lindsay, do you have some comments around the cash position as investors move through this particular time?
Yeah, well, that's a great segue here, because what does an investor do when they're up against mounting economic uncertainty and bouts of volatility? Most investors are not flocking to money market funds for the yield when it's this low, of course. But however, there's a record amount of cash on hand. You can see in this chart that in 2020, we've reached over $4.6 trillion of money market funds. And that's just money market funds like this chart, but also bank deposits are at a high. There's really two reasons here that we see investors in cash. One is for the safety of cash, if they think that maybe stocks have soared too high, too fast. Or another is to keep cash ready to deploy when there is an attractive buying opportunity. Another point, and we'll come back to that buying opportunity in just a second, but another point here is those who have been fortunate enough to keep their jobs through this have been spending less, saving more. For example, if you're staying home, you're traveling less. We've noticed that a lot on our financial planning projections. But to go back to the keeping cash ready to deploy, whether there's an attractive buying opportunity, I do see that we just got a question in that actually will kind of be answered here. The question is about tactically changing client portfolios to benefit or lessen the risks, any changes in our positions during this volatility. So Jason or Dax, can you comment on what we're considering for our client portfolios, that may be holding some cash or we're not holding cash at this point?
Yeah, and I think that's a great question. And we want to look at, when you're constructing a portfolio, you have a number of assets. You have cash, you have bonds, you have stocks, both international and domestic, and then you have real assets such as gold and real estate. And so when we're considering the totality of how to put a portfolio together, we have to consider the risk and return of each of those asset classes separately, as well as how they work together. So traditionally, stocks and bonds have an inverse relationship, especially in times of financial distress. And so I do think that a lot of people have moved to cash as a safety mechanism because they're maybe scared of some of the market volatility. However, when you look forward and you look at financial objectives and goals of each of our clients, we also have to consider other risks, such as shortfall risk. And so right now, if you're in cash over the long term, you're going to see an erosion of purchasing power. And so we'd also need to consider parts of the market that maybe have better return potentials than cash, or even bonds that are yielding 1.5–2% right now in this current environment. There are other parts of the market that we're looking at that have a higher yield and maybe a bit more volatile in the short term, but also can get investors, when you consider the totality of portfolio construction, into a better place to reach some of those financial goals. And even though we've seen some of the largest stocks drive the markets up, there are still some areas that we're actively researching on the investment committee that haven't seen the recovery and are still below their peaks from back in February. So Jason, I know that we talk a lot about the dividend yield on stocks in certain sectors versus what bonds are yielding right now. What are we currently viewing in the market as potential opportunities based on what we're seeing?
Yeah, perfect. We'll just switch to the slide. So it's interesting. The creator of this chart titled it the Dove-idend yield. And so if you don't know, the term dovish refers to an easy monetary policy by the Federal Reserve or any other sovereign entity. But due to the Federal Reserve dropping short-term interest rates effectively to zero, the yield on all other bonds price off of that Fed-controlled rate, and they've dropped tremendously as well, as Dax mentioned a moment ago. And so this slide really just hits on the point that the current dividend yield that you get on many companies around the world is higher than what you can earn on U.S. government bonds in this case. And now, I got to note that investing for dividend yield still involves stock market risk. And so different types of risk have to be assessed and kept in mind when you're implementing any investment strategy. But the low yield on bonds are challenging for income-oriented investors right now. And so we're increasingly looking for sources of income and return that's still diversifying in nature when you consider it within a portfolio, but have better forward-looking prospects. And so, things we've done in the past and are continuing to explore ways to tweak. You've heard us mention things like the versus funds. We had one of those guys, one of the managers of that company come and speak with us a couple of weeks ago. But those have offered good income generating potential with good diversification benefits. On the stock side, throughout this volatile time, we've utilized some products that are able to buffer some of the downside moves, but participate in some of the upside if the market recovers. And so we try to use those tools where appropriate. It's not going to be appropriate in all cases, but we try to use those where we think that it makes sense within the context of the portfolio and for the risk category a client is in. But one area on the income generation slide are high quality dividends. Good quality companies that we think are going to be able to continue their dividend policy in the months and years ahead. Again, that's not a strategy that's going to be appropriate for all clients, but it could become a bigger focus at some point if we're able to get better income generation from companies on the from their stock portfolio versus what we can get in good quality bonds at the moment. And so, thinking about the recoveries in the U.S. stock market this year, thinking about the S&P 500, we may have shown a visual for this in our recent chat, but a large portion of the rebound has been attributed really to just a few companies. It's the big guys. It's Amazon, Apple, Google, Microsoft. We have good exposure to those in the portfolio, but if you look under the hood, there's still, dozens, not a couple, a few of the hundred of the S&P 500 companies that have not had that level of appreciation in the past few months that those few companies have. Those few companies make up such a concentrated portion of the index that their good performance has pushed the index higher. And so, thinking about where do we go from here, a lot of the conversations we're having internally about how to position portfolios are discussing some of those areas that haven't recovered to the same extent, but where you can still find good quality businesses. I mentioned the dividend focus for some of the income-oriented investors, but for more growth-oriented clients, smaller companies that, perhaps good companies that got thrown out with some of the bad ones when, thinking about some of the data we talked about a moment ago, some of those, there are areas that are starting to look interesting that offer still good forward-looking upside potential that hasn't been realized by the market just yet. And so all to say is we're evaluating different areas of the landscape. Dividend strategy is one of them, but trying to figure out where it's going to fit in the balance of a diversified portfolio. And ultimately, as you mentioned a moment ago, Dax kind of gets back to what's going to allow someone to meet their financial goals in the long run.
I think we have one other question, guys, about just the focus going forward on our investments, maybe looking more at companies rather than ETFs and mutual funds. Any thoughts there?
I would just say that, that's going to be on a client-by-client basis. I think that the product landscape and the stocks are diverse enough that you can find, exchange-traded funds that or mutual funds that focus on some of those higher quality businesses or have that theme of focusing on good quality dividend companies. And so that's what we've tended to use in the past and would likely use to a greater degree across the board. But there are instances for certain clients where individual companies may make sense to be used. But particularly right now, given the level of uncertainty, it's somewhat difficult for us to say that one business is going to have a better outcome than another business. And we would, in most cases, we find it appropriate to diversify across multiple companies, and we can do that efficiently with the ETF products. And so I think going forward, we're likely going to continue to lean on those, but for certain clients where it's appropriate, we may be willing to take a few more rifle shot opportunities if we think it's going to lead to a good outcome for that particular client.
I think that makes sense. And, there's so much out there in terms of investment tools, whether it's ETFs, exchange traded funds, or mutual funds, and you can get pretty narrow in your focus. And so I think there's just a lot of opportunity beyond just individual stocks for sure. But I think this last chart is a good segue kind of to feed back and follow up on a little bit more about our tactical management and how we see the world. So let's look at this chart and then we'll wrap up. So here we're looking at historical performance of stocks and bonds, as well as a blend, 50-50 blend of stocks and bonds, more in a portfolio context. And that may help us as we frame kind of looking out the front windshield now and thinking about future prospects. So this chart represents 70 years from 1950 to 2019, or through 2019, so 70 years. And I think a few key takeaways, we're looking at different periods, of 1 year on the left, and as you go across the bottom, you can see 5-year rolling, 10-year, and 20-year rolling periods. And what we're thinking about, or at least what I'm thinking when I look at this, is I think about time being your friend. And I say that meaning that as you go further out, we talked a lot about the Benjamin Graham saying about short term, the market's more a voting machine, more based on evolving sentiment and behavior aspects. But then as you go further out, it gets more quantitative, fundamental in terms of those things that really matter, like earnings, for example, economic growth, that are much more easier to predict the longer out you go. And so your range of returns gets much tighter as you go further out. Notice how 5-year, 10-year, et cetera, a lot tighter ranges on your outcomes. And then the 50-50 portfolio, 50 stock, 50 bond portfolio also introduces diversification and risk reduction. And so those things kind of mean to me that if you got a strategy and you're consistent, it's more about that time in versus trying to time the market. And also I think it just suggests that these are traditional assets. And so when we think about traditional assets, we're thinking stocks, bonds, you can throw cash in there as well. And as we look forward, I think it's it can be challenging because bonds had a great environment with a declining interest rate environment over a good portion of this time frame, at least back to the early 80s. And so we're not expecting bonds to carry as much weight or do the heavy lifting as much in the portfolio. And then we look at stocks, you say, hey, well, maybe they're a little bit more elevated or not quite a bargain price they were, earlier. And so you've got lower yields on the bond side. You've got stocks that are at least fair to slightly elevated. And so your starting point matters. And so when you look forward, you probably have to be a little more moderate or modest in your expectations of future returns, at least over the next several years. So what is that? That's kind of making us look at other areas and try to figure out if there are other areas, alternative investments, other investments that can add value either from the risk or the reward standpoint, or when you marry those two together. And so that's the reason why, as we've discussed, we've looked at things like alternative investments, whether that be real estate, real assets, tangible assets, gold. There's just been a variety of things we've tried to introduce or at least consider to help us get through this and try to help clients have both stability returns and get them as safely as possible and have less volatility to their ultimate objectives, long-term goals. So, I will mention that kind of we have, more of the growth and income clients, which tend to be folks that are a little more conservative. Maybe they want a combination of growth and income. And so then you have on the other side, you have more of your growth clients who are looking more for longer term growth of the portfolio. And we've taken different approaches there. I mean, obviously they have different objectives. And so especially during this period of heightened volatility, we've had to take a little different view on each one, maybe a little more risk mitigation on the growth and income, and at times a little more optimistic things on the growth side. And I will mention it's very, very uncertain. And as we talked about, the zombie corporations, I think, that we talked about earlier, I think that's the reason why we're staying a little more high quality at times and trying to focus on companies with strong fundamentals. So as we kind of wrap up this slide, I think I'm going to turn it over to the group to kind of further expand on kind of how this impacts our posture and our outlook as we look to manage client portfolios. So does anybody want to lead off with some thoughts there?
Yeah, Glenn, I mean, I loved what you said a lot about time horizon, because as the financial planner in the group, I'm sure that's the one thing that was really ringing at me is, every client is one size fits one, as we like to say. So, we can't fit all of our clients into one box. That just would be impossible. So we're really looking at each client's time horizon. If you're someone who comes in and you're 80 years old, you just want your income to be comfortable, and you want to maybe pass some assets to your heirs. Or somebody who's coming in and they're, in their 40s, they're in their prime income earning years, they're still going to be accumulating, and maybe they have other goals like to retire early or maybe to pass a large inheritance to their children. There's just so many different nuances, so many different goals that our clients have. And I mean, that's why we love what we do, is because every client is so unique, and that time horizon and those goals are as unique as a snowflake or a fingerprint.
Yeah, that's a great point. I tell you, it is, I think once again, we want clients to understand our rationale. We're not going to get every call right, but we want at least hopefully have a good baseline, a good rational framework on why we're doing things. And I think as long as we communicate that and clients understand why we're doing things, they obviously can judge the decisions for themselves, and they may decide they want to reconsider strategies depending on their personal circumstances, or they may give us additional advice on how to lean into certain areas versus others. But it's all about the relationship and that trust and communication. And I think we're going to continue to make the best decisions we can. But any other thoughts, anybody else on that?
Yeah, Glenn, I like what you said about kind of bifurcating some of our growth and income clients versus our more aggressive clients, because at the end of the day, to Lindsay's point, we do want to lean back on our financial planning. And what's most important is not necessarily, we want to be opportunistic and get returns for our clients in line with how much risk they're willing to take. But more than anything, we want to make sure that we raise the probability that they're going to meet whatever financial goal that they have. And as you can see, as you go further in time, your range of outcomes decreases. And as you mix asset classes, your range of outcomes decrease. And so that's what's important when you're thinking about pairing planning with your portfolio, is to make sure that you have an investment objective where you have the mindset where you can stay invested if it does have some volatility, but also that you're in the investment objective that can meet those financial planning goals that you may have given your time horizon. So I think that is the two most important things that I got out of the final slide that we showed.
Good deal. Well, I think we probably run over a little bit our time allotment, but it's been great conversation, and I hope everybody's found this just very informative. So on behalf of Lindsay, Dax, and Jason, we really appreciate your time. Once again, hope you found this a productive and time well spent session. And I think our next live Let's Talk About It chat presentation will be in 2 weeks. It'll be July the 10th. And we'll have a Sailing in Uncharted Waters at that time, our normal 11 a.m. Eastern time. And then we also have a 4 p.m. Eastern chat. I think it's more around a special interest. We'll have a guest, I think, from Intel. So discussing more the Internet of Things and kind of how we're looking at a truly interconnected world. So once again, please be on the lookout for more information on this. And we hope everybody has just a great, safe week ahead. And for those of us in the U.S., we hope you have just best wishes for the July 4th week. Thank you for your time.
Thanks.